Assalamualaikum warahmatullahi wabarakatuh. Today, I'm Adil Zaini bin Hamzah and my friend Muhammad Irfan Fathi will present about the Murabahah car financing contract. Next slide. Okay, Bank Negara Malaysia or BNM has given the definition towards Murabahah contract. It is stated in their report that Murabahah refers to a sale and purchase of an asset where the acquisition cost and the markup are disclosed to the purchaser. Based on the definition given in the Investopedia, Murabahah contract also referred as cost plus financing. It's a structure in Islamic finance where the seller and purchaser have agreed to a fixed amount consists of cost price and the markup price or profit margin in the acquisition of an asset or property. The markup or profit margin is the substitution or the substitute of interest on loan. Profit margin in Islam is halal or permissible in Islamic law, but not for interest because interest is categorized as riba or usury. Next slide, please. Now I will let my friend Muhammad Irfan Fathi to continue the presentation.
All right, thank you, Adil. Okay, now we will talk about modus operandi. Sorry, I repeat. Now we will talk about modus operandi in Murabahah contract. So it has six modus operandi. So the first is Islamic bank negotiations with the customer on the intended asset. All right, the Islamic financial institution or Sharia banks made a negotiation with the customer on what asset or property that the customer wants to buy. So the second is about Islamic bank purchase the asset with the customer's specification. So the Islamic financial institutions or the Sharia banks purchasing the object or the asset with the specification given by the customer. And the third is Islamic banks sets the contract with the acquisition cost and markup price. So the Murabahah contract has been made and set by the Islamic financial institution that includes the cost price and the markup price or profit margin in the Murabahah contract. So the fourth is customer visit the supplier to proceed with the purchase. So the customer visit the supplier. So the customer visit the supplier to proceed with the purchase. And the fifth is about the customer receive the object, its assets and the papers from the supplier. And the lastly is about the customer pays the bank installment as agreed by both parties. So so the next slide I will give to Zaini.
Okay, thank you, Muhammad Irfan. Now, I will continue the presentation about the components of Murabahah contract. The components in Murabahah contract. The first component in Murabahah contract is the legal capacity of a person. From Sharia perspective, the legal capacity of a person is defined as the capacity to assume rights and responsibilities and the capacity to give legal effect to his action. Other than that, one of the most important conditions is that the person must possess a very sound mind and the capacity to distinguish or differentiate between what is harmful and what is beneficial to a person's interest. Secondly, contracting parties may be a natural person or a legal person. one of the parties or any party can enter into the Murabahah contract through an agent. Naturally, a contract needs the agreement and understanding between both parties. The Murabahah contract is also similar. The Murabahah contract must be entered into by the acceptance of both contracting parties, whether the seller or the buyer. The appropriate documents are needed in the process of offering and accepting. Any other methods are also accepted, like the uruf tijari or the methods accepted by customary businesses practice, as long as it does not contravene or contradictive with the Sharia law and principles. Thirdly, the components of Murabahah is the asset or the property involved. There are a few conditions to be met by the asset to be traded in Murabahah contract, such as the asset is recognized by the Sharia, valuable, identifiable, and also deliverable. Then the asset is already exists and owned by the seller, which is the Islamic financial institution. Lastly, the price of the asset. The price amount or even the type of currency involved must be agreed by both parties when entering into the Murabahah contract. The price should be set up that consists of cost price and the additional of markup price or profit margin at the time of entering the Murabahah contract. The cost of acquisition, like direct expenses which enable the acquisition of asset by the seller, and the delivery to the purchaser may be included as a form of cost portion. These expenses include valid expenses which are established by customary business practices or uruf tijari. Next slide, please. Okay, Muhammad Irfan will continue the presentation until the end.
All right, thank you, Adil. Okay, so this is the last slides. It's about risk in Murabahah contract. So it have 4 risks for Murabahah contract. So the firstly about the delay in payments of installment. Delay in payments installments. It refers to delay. It refers to delay in installment by the customer in pursuance of the agreed Murabahah payment schedule. In such a case, the bank may inflict a penalty to the customer, same as the conventional lending, but the amount of penalty is channeled to charity account has mutually agreed in the agreement instead of recognized income of the financial institution. All right. So the Islamic financial institution suffers the shortfall of cash inflow, which is not compensated by the customer, as the penalty amount is channeled to charity account of the bank. So the secondly about default in payment of Murabahah at the time or after maturity of facility. All right. So in MPO, the Islamic financial institution is not allowed to charge the customer with additional payments, unlike conventional banks. The price of the asset at the time of sale in MPO cannot be increased even if the facility period is matured. Hence, the customer cannot be charged for the days above the maturity period in case of default. It also not permissible to arrange restructuring or rollover of Murabahah facility by the bank in order to be compensated for the delay period. So the third is about commodity price commodity price risk. As mentioned earlier, the Islamic banking deals in asset. Therefore, the risk of managing and handling of asset are additional risk indicators to be considered A commodity price risk arises as a result of the bank holding commodities or durable asset of the time between the taking ownership and possession of the commodity from supplier till selling the same to the customer. Science definition institution holds the ownership in the mentioned interval. Any significant decline of price of commodity may affect may affect uh may affect the intentions of the customer to withdraw from his decision or commitment under master murabahah agreement. In such a case, the financial institution is left with no option but to sell the commodity on the same low price in the market and is exposed to suffer loss. So the lastly about exchange risk, it has to be kept in mind that the profit of murabahah can only be charged subsequent to the sales carried out with the customer. There might be instances that the price of commodity is credited to supplier and the delivery of commodity may take place a day or few. In this instance, the profit charging takes place at the time or after the sale process between the bank and the customer. The financial institution is exposed to exchange risk if the payment is made in foreign currency to supplier residing out the country and the customer has been extended with murabahah financing in local currency. So it is due to the fact that the currency exchange took place or at one rate at the time of crediting suppliers account and the exchange rates may differ at the time of sale declaration. So that's all from us. Thank you.